Yeah, thank you very much. Welcome, friends from all over. I see a lot of people have joined from different parts of the world, including as far as Colombia, Brazil, and New Zealand. And it's surprising that this educative sessions have attracted a lot of people from around the world, and Netherlands and US and other parts of the world. So I think it's a great delight that the whole world is coming together thanks to technology. And so I must say good evening to everybody in India, and good evening, late good evening to the people on the Eastern Hemisphere, and good morning on Western side, and good afternoon in Europe and other places. So welcome once again back to this International Tech Series. And we'll continue our discussion on digital economy. As you all know, a number of issues that we have been discussing on digital economy. I think today we'll take it forward. And I'm really delighted that Vikram Chan, whom I've known long time, and also Radhakishan, Rawal, a renowned name in India, have been so generous in contributing not only the chapter, but found time to come and talk to us today and share their experiences, ideas, thoughts, etc. And it's a very, very good thing that I think we are all coming together to do something interesting. And of course, Rajesh, thank you so much, for being the pillar of international tax at the firm. And I would request you to now take over the reins and moderate this session. I'm sure we'll have very exciting time. Given the experience of the past, every time we have to extend it by about 15 minutes. So today, I think let us make it that by 8:30 we'll finish it. And just be patient, because this is an opportunity, not you get it every day. And people have been joining from, Vikram has been joining from, I think, Switzerland. Which part of Switzerland you are in, Lausanne or Geneva? Or where are you, Vikram?
I'm in Lausanne right now.
Lausanne, right? Exactly. I think it's been wonderful, and thank you, Radhakishan. So people like that, I think, coming and joining us, I think we must thank them profusely for their contribution and enthusiasm in sharing their knowledge, experience, and insight into the subject of digital economy today. Over to you, Rajesh. Thank you.
Thanks, Nishith. I think we have two very interesting perspectives, because whenever we talk about digital economy, for a lot of people in India, we think at what is happening in terms of the changes to the Income Tax Act, whether it's the concept of significant economic presence, or we think about the equalization levy. But at the same time, there has been a lot of work which has been happening at OECD, where the move towards working on Pillar 1 and Pillar 2, more in terms of trying to see how do we address the whole issue around digital economy, and in respect of how do we ensure that there is appropriate allocation of taxing rights insofar as the source country is concerned. Do we bring in new standards in place? Do we bring in new concepts of profit attribution? So we have two different topics that are, and both very related to each other, that we are looking at covering today. Dr. Vikram Chand is going to start off and look at what the OECD has been doing in terms of its approach to digital economy, the whole work on Pillar 1 that they've been doing. And that will be followed by what has been happening in India, where Dr. Radhakishan Rawal will be sharing his thoughts and his insights around what is happening in India, and post which we will obviously have time for Q&A. So without spending too much time, but sort of leaving it to Dr. Vikram Chand to take it over. Vikram, over to you in terms of introducing and taking over on the whole concept of Pillar 1 and the work that OECD has been doing.
Okay, so thank you for this nice introduction. So what I'm going to speak about today, actually Pillar 1 of the OECD's unified, the OECD's project on digitalization, which essentially deals with the unified approach. Now, just to give everyone a background, So the OECD is working on its project on digitalization of the economy since the BEPS project was initiated in 2013. A series of reports had been released by the OECD, and they have actually classified their work in two pillars. Pillar one deals with allocation of taxing rights to market countries in light of the fact that there is this move towards centralization for multinational enterprises. And pillar two actually addresses some remaining profit shifting issues and the race to the bottom kind of tax competition. I'll be just focusing my presentation on pillar one of the OECD's unified approach. Before we get into the unified approach, let me just give you the background to the entire work that has been happening since a very long time. So let me just start by speaking to you about what the current framework is with respect to taxing cross-border business income. So under the current framework, business income is actually taxed in the state where an enterprise has its production factors or its origin factors. And this is not something new. This has been actually flowing down from the work that had been done by the League of Nations as well as the four economists in the 1900s. So like I had mentioned, under the current framework, business income is taxed in the country where you have the factors of an enterprise, and in the post-BEPS world, it is called value creation factors. So just to give you a very simple example, so if we have a company which is resident in Switzerland, and in Switzerland, if this company has all its value creation factors, production factors, origin factors, such as people, assets, and employees who are actually working on building a particular product. So if you have a company in Switzerland actually selling, let's say, chocolates into a market country, for example, in Spain, and if this entity receives business income, then under the current framework, this entire business income is taxed in Switzerland. But on the other hand, if the production factors are based in the market country, then according to the benefit principle essentially says that a state can exercise its tax jurisdiction if a non-resident enterprise is benefiting from public infrastructure. So if the enterprise, which is a resident in Switzerland, has some production factors in Switzerland in the market country, or value creation factors or origin factors, then the market country has a right to tax that business income too. And these value creation factors or production factors like people, assets, employees, in other words, functions, assets, risks, can also be a part of can actually be a part of a separate legal entity like a subsidiary, or it could be a part of a branch, which is a part of the same legal entity. With respect to profit allocation, in order to allocate profits to this branch or to the separate legal entity, since the early 1930s and late 1920s, the approach that was suggested was using the arm's length principle. That is where the work of Michel B. Carroll, as well as the work that was done by the United States government with respect to transfer pricing kicks in. So in the early part of 1930s and subsequently, many countries started using the arm's length principle to allocate profits to a subsidiary or to a permanent establishment. So for example, once again, if we have, let's say, Lindt in Switzerland, and Lindt is selling some chocolates in the market country and it's receiving business income and through its value creation factors in Spain, then in that kind of situation, Spain has a right to tax that business income because there's a separate legal entity or a permanent establishment therein. Now, from a profit allocation perspective, it's usually the arm's length principle, and I think everyone here knows what the arm's length principle is. It allocates profits to the PE or to the subsidiary based on the value created by the PE or the subsidiary by looking into what comparable independent enterprises would actually do. So this is the current framework for taxing cross-border business income, and in our example, the market country can typically tax the cross-border business income only if there is some physical presence therein. So what is the issue with digitalization. Now, with the rise of digitalization, you have many multinationals who can actually use, first of all, move away from tangible factors, and they move more towards the use of intangible factors. And by doing that, they avoid physical presence in market countries. At the same time, you have some businesses create and exploit user networks. They heavily depend on collecting user data and exploiting that user data. This would be typically companies like Facebook or Google or other online marketplaces. And because these businesses can operate on the internet, they can scale rapidly on the internet, they can avoid physical presence in the market countries. So essentially, multinationals compared to the past, where they used to operate with brick and mortar kind of businesses, now with the help of digitalization, they can centralize their activities in one country, operate in a centralized fashion from one country with very limited or absolutely no physical presence in the market country. Now, this analysis, what I've just made here, applies not only to certain highly digitalized businesses, but it also applies to traditional businesses who are using digital means quite on a regular basis to somehow enhance the customer base, as well as making sales to their customer base, so by using digital means. So the big question here is, how do you allocate taxing rights more to market countries? Because big multinationals can tap into digitalization or the internet phenomenon, and they can do substantial business in other countries. In early part of 2019, the OECD had released a public consultation document, and in that public consultation document, 3 proposals forward. One was a user participation proposal. The second proposal was a significant economic presence proposal, and the third was a marketing intangibles-led proposal. The user participation proposal was actually proposed by the UK and the EU, and this proposal applied only to a small set of highly digitalized businesses. So it only applied to online advertisers and online marketplaces. Whereas then you had the Indian proposal, and which was reflected in the significant economic presence concept. And this proposal actually applied, it seemed to apply only to a broader set of highly digitalized businesses. So if you look at the user participation proposal, which applied to only selected digital businesses, significant economic presence proposal, which applied to a broader set of digital businesses. For example, they applied to cloud computing business models. They applied to Netflix, who are in the business of online content. It applied to online gaming, so on and so forth. So the SCP proposal applied only to a broader set of digitalized businesses. Whereas then you have the US proposal, the marketing intangibles proposal, which applied not only to companies which were caught by this user participation proposal, the significant economic presence proposal, but applied to companies on a much more broader basis. It applied to companies who were actually mostly consumer-facing businesses. So multinationals which were consumer-facing multinationals. So these 3 proposals were actually put forward. Interestingly, I analyzed all the public comments in relation to these 3 proposals. And the most famous proposal by all the commentators, by businesses, the businesses supported the marketing intangibles proposal, whereas the governments as well as some NGOs supporting the significant economic presence proposal. These 3 approaches, in one way or another, in the late part of 2019, were combined into something known as a unified approach. In January 2020, the OECD also released a document with respect to this unified approach. So what are the key features of this unified approach? So the unified approach proposes 3 amounts. One is an amount A, second is amount B and C. Now, amount A of the unified approach is the most interesting part of the unified approach. Why? because the unified approach, amount A of this approach, moves away from a separate entity approach. If you look at currently profit allocation within a multinational, the arm's length principle, approaches every establishment within a multinational. The establishment could be a permanent establishment or it could be a separate legal company. It approaches every establishment in a multinational on a separate entity basis. So this amount A actually moves away from a separate entity basis and treats the multinational as one taxable unit. So you have a big multinational with 100 subsidiaries. So this entire multinational on a consolidated basis is considered to be one taxable entity, one single economic unit for tax purposes. So amount A moves away from this separate entity approach and the arm's length principle, which is linked to the separate entity approach, towards a M&E group approach with respect to profit allocation. And this applies to not to all businesses, which we will see a bit later. It applies to consumer as well as user-facing businesses and certain automated digital services. To allocate profits, there's a 4-step mechanism to which I will refer to a bit later, and also we'll be discussing a couple of case studies. On the other hand, you have amount B and C, and amount B and C actually stay within the existing system. So the existing system is the normal transfer pricing system, which is built on the separate entity basis, and amount B and C stay within the system. So amount B, what it does is that it allocates fixed returns to some routine distribution and marketing entities with the risk, and the entire logic of this is because there is a lot of litigation associated with limited risk distribution structures or limited risk marketing service provider structures. So they want to somehow reduce the litigation associated amounts and with these kind of structures and fix an amount. On the other hand, amount C allocates higher returns to all local entities within a multinational if they do more than routine activities. Currently, the scope of amount C is still highly undefined, which we will also see a bit later in the presentation. So just to zoom in a bit more on the proposal. So in terms of scope, the amount A of the OECD's unified approach applies to M&E groups whose revenue would exceed around 750 million euros. This is a similar threshold which you see in country by country reporting standards. This proposal applies to automated digital services, so M&Es which are in automated, which can be classified as businesses providing automated digital services. For example, online search engines like Google, social media platforms, Facebook, Instagram, online marketplace, Airbnb, Booking.com, Uber, online streaming services such as Spotify, Netflix, online gaming, partypoker.com, cloud computing services, Microsoft Azure, online advertising, which you already know as Facebook or Google. It also applies to consumer-facing businesses. And what kind of consumer-facing businesses? Businesses typically which are engaged in personal computing products. For example, Apple, which sells the Mac, or Samsung, which sells laptops. To big clothing companies, Gucci, Armani, toiletries, Procter & Gamble, luxury goods, so on and so forth. It also applies, interestingly, to franchise models. So companies like McDonald's, Starbucks, they will also be covered by this proposal, including certain automobile companies. Interestingly, some sectors have been carved out from the scope of this amount A allocation, and it's typically businesses which are in extractive industries. So business which is engaged in digging oil from the earth, they are actually excluded, and businesses which are actually selling raw materials. So for example, if you have Brazilian commodity, Brazilian coffee, Brazilian company which is dealing in commodities and selling coffees to Nespresso, so the Brazilian company will be out of scope, whereas Nespresso, because it's a consumer-facing business, it will be within scope. There's also an exclusion for shipping and airline companies, because if you look at tax treaties under Article 8 of the OECD model or the UN model, there are some specific rules for taxing shipping and airline companies. So they wanted to exclude these companies also. and moreover, certain financial services would be excluded. With respect to nexus, with respect to triggering nexus in a market jurisdiction, for automated digital services, there will only be a local revenue threshold, whereas for consumer businesses, there would be a local revenue threshold plus certain plus factors, coupled with certain plus factors, which I think have been actually taken from the SCP proposal. And these these plus factors could be, for example, targeted advertising expenses linked to a particular jurisdiction. But the bulk of the nexus test, because under the current PE definition, if you look at it, the nexus to a country is determined on the basis of some kind of physical presence in the country. But now nexus would be determined only on the basis of revenue thresholds in most of the circumstances. Interestingly, for profit allocation under Amount A, a 4-step approach is provided. And this 4-step approach is based on the consolidated financial statements of a multinational. So under step 1, we need to determine the profit margin of the multinational group. Second, and this can be done by just looking into the consolidated financial statements of the M&E. So you determine the profit, the consolidated profit, the profit margin of the M&E group under step 1. For example, if it's, let's say a M&E group is operating with a profit margin based on its consolidated financial statements of 30%, then out of this 30% actually is representing the profit before tax by sales. From this 30%, you exclude a routine profit margin, and then the balance would be a deemed residual profit, will be a residual profit margin. And then the deemed residual profit margin would be split between production related and market related margins. So for example, if the M&E group is operating with a margin of 30%, let's assume that they say 10% is routine and 10% is a routine margin. So 20% in our example would be a non-routine margin. That will be a residual profit margin. This residual profit margin of 20% would be split once again between production related margin and market related margin. So once again, some percentages will be deemed here. So let's just go on an 80-20 split. So 20% of 20 would give me around 4, if I'm not mistaken. And then 4% of the sales, of the global sales, would be up for reallocation to the market country. So at this stage, I would just like to say that this 4-step approach somehow resembles the existing profit split method, which you see in the transfer pricing guidelines. This is just a modified version of the profit split method, but by using fixed percentages. Now, all these fixed percentages that I'm referring to in step 2 and step 3 of the exercise here would be somehow discussed and negotiated by all the members of the inclusive framework. So naturally, if there's some kind of profit that has to be allocated to the market country, on the other hand, some other countries will have to provide relief from taxation, taxation with respect to the taxes paid in the market country. So this proposal would need to identify some surrender jurisdictions. Surrender jurisdictions could actually be the jurisdictions in which the M&Es are actually booking residual profits. And if you have some M&Es which are operating with centralized principal structures or centralized business models, then it's typically the centralized entrepreneurs who will be providing relief. So if, for example, the traditional, generally speaking, multinationals usually set up centralized entrepreneurs in countries like Netherlands, Luxembourg, Switzerland, Singapore, Mauritius, and so on and so Hong Kong, so on and so forth. So these are the traditional jurisdictions which will have to provide relief from double taxation. Whereas in cases of decentralized business models, it's the burden to provide relief would fall with the local entrepreneurs. And with respect to eliminate double taxation, you have 2 methods, which I think everyone will know about. You have the credit method and the exemption method. But this proposal seeks to follow a new approach, which is somehow linked to the exemption method, which we can see a bit later too. With respect to disputes, of course, there are going to be many disputes with respect to amount A. So disputes, whenever I think about disputes, I put them in two categories: prevention, and the other one is on dispute resolution. So with respect to dispute prevention, I'm assuming that the OECD is going to provide extensive guidance, scope, nexus, profit allocation, surrender jurisdiction, and revenue sourcing rules, as well as the same time for dispute resolution. I'm assuming something will be proposed in the form of arbitration, but it will not be called arbitration because developing countries are allergic to arbitration, especially in India. People don't like mandatory arbitration within tax treaties, or they've not even signed up to the MLI arbitration provision. So in India, mandatory arbitration is not so famous. But still somehow there will be a binding dispute resolution mechanism that will be built up. But I don't think they'll call it arbitration. They'll call it something else, but I don't know what it is. But it will not be arbitration. With respect to implementation of this entire amount A proposal, if you look in the current framework, under the current framework, usually countries enter into bilateral tax treaties with each other for tax matters. But this, I'm assuming, because amount A is an add-on system, it is being applied at an M&E group level. So there will be a new multilateral convention on tax matters. It's not going to be an MLI, because what the MLI does, the existing MLI only modifies bilateral tax treaties. This will be something different than the MLI, because to implement amount A, you don't really need bilateral treaties in place. So this has to be something on top of tax treaties, like a multilateral convention, purely on tax matters. And this is where, once I was speaking to Nishith, and Nishith also was mentioning that we should have one world, one tax. I think this is somehow a new multilateral convention on tax matters will be developed, where at least there will be one M&E and somehow a common set of rules to decide on what that M&E's taxable base should be in every country. So a new multilateral convention will be proposed. It has to be done. I don't think an MLI route is feasible. So a new multilateral convention needs to come in. With respect to information reporting, I think what's going to happen is that they're going to modify the CBC reporting threshold or the contents of a CBC report in order to ensure that all the new information in order to implement this approach can be reflected in CBC reporting. With respect to payment of taxes, of course, under amount A, the M&E group has to decide on its entire tax bill. So what's happening here is that the tax bill will be decided at the M&E group's level. The M&E group will pay its tax bill to the parent, to the jurisdiction where it is headquartered, to the tax administration there, and then the tax administration will disperse off the tax liability for each jurisdiction, and then they will pay it. So the burden will be less on the companies, but more on the tax administrations to ensure that the cash will be remitted to the other tax administrations. Then you have amount B, and amount B is, like I mentioned, it's within the existing system. It somehow tries to provide fixed profit percentages with respect to certain baseline distribution and marketing activities. It will not apply to entities or establishments which are doing more than routine activities. So it really applies to routine activities, and somehow these percentages will be fixed. To give you a more concrete example, I will do a little case a bit later so that everyone can understand this concept. With respect to amount C, so whatever is not covered under amount B is somehow going to be covered in amount C, but the scope of amount not yet decided what it will actually include. So there are two views. One view says that it will include only additional marketing and distribution activities which exceed the baseline activity, whereas another set of views says that it also includes all other business activities in a country which is unrelated to marketing and distribution. I think the key message that I would like to pass on is that Amount A is the most interesting part of the approach. Why? Because it moves to a completely new system. So in the near future, you will have an existing system. So you will have bilateral tax treaties, transfer pricing rules, which are based on the separate entity principle. And at the same time, you will have a new M&E group system that is going to be built on. So the new M&E group system is an add-on to the existing system. So you'll have these two systems existing simultaneously with each other. And I think that's going to result in a lot of work for tax practitioners as well as a lot of work for tax administration. And it's something which is going to create a lot of interest in the near future. Now, just to be a bit more concrete, I'll just try to explain amounts A, B, and C through with the example of a centralized consumer good business model. Let's just let me just give you an example. So if you just take the existing system, so you can have a parent company in the US, and this company has developed all the trade and marketing related intangibles. Now, this company, let's just say it assumes, let's assume that it licenses all its intellectual property to a principal company, for example, in Switzerland. And this principal entity in Switzerland is will pay our royalties and arm's length royalties to the parent in order to, because it's exploiting its IP. Let's assume that this principal is doing business with the use of toll manufacturers and limited risk distributors and full-fledged distributors, so on and so forth. Now, let's just assume that this principal is selling its goods in the Netherlands on a remote sales basis. It's selling then its goods in in Germany on a limited risk basis by using a limited risk distributor, and remuneration of the limited risk distributor is, let's just assume it's 2% on sales. And finally, it's operating with a full-fledged distributor in France, and the return on sales of this full-fledged distributor in France is 8%. So under the current framework, if you just look at it from the perspective of market countries, and I will just restrict myself to Netherlands, Germany, and France. So in Netherlands, the company is making sales on a remote basis, so no tax. In Germany, because it's operating with a limited risk distributor, it will pay a tax on the taxable base of the limited risk distributor will be 2% on sales. And then finally, in full-fledged distributor in France, because the full-fledged distributor does a lot of takes a lot of risks in it, a lot of risks such as especially the credit risk, marketing risks. Let's just assume that it's being compensated on a 8% return on sales. Now, let's just say that this M&E group is selling branded consumer goods, and let's just do a simple case study. Let's assume that as per the consolidated financial statements, the group revenue is around 1 billion. The consolidated expenses is around 600 million, and the group profit, earning before taxation, is around 400 million. Now, let's just assume further that 10% of the global revenue is from Netherlands, 20% of the global revenue is from Germany, and 30% of the global revenue is from France. So how would amount A actually work in this simple example? So in order to allocate profits or to determine the taxable profits, but before we get into that, in order to know that whether the M&E is within scope or not, I just wanted to tell you that since this is an example of a luxury goods consumer company, it will be in scope, and because its sales are 1 billion, so it crosses the group revenue threshold, so it's within scope. Now, let's just assume that the nexus test is satisfied in each market jurisdiction, and the sales in each market jurisdiction exceeds the revenue threshold that will be proposed by the OECD. Because like I mentioned to you before, nexus is going to be determined, nexus to a country is going to be determined based on certain revenue thresholds. Assuming that the revenue threshold would not be extremely high, it could be around 5 million or 10 million. As soon as you hit this revenue threshold, you would fall within, you would satisfy the nexus test. Now, with respect to profit allocation for this enterprise, a 4-step mechanism is being proposed. And the 4-step mechanism will work like this. So firstly, you need to determine what the operating profit margin of this multinational is. So based on the consolidated financial statements, we see that the operating profit margin is 40%. Then out of this 40%, let's assume that the inclusive framework, which is working on the solution, says that a deemed routine margin is fixed at 10%. So out of 40%, 10% is deemed routine margin, and 30% would then be deemed a non-routine margin. Then this deemed non-routine margin would be split between production activities and market-related activities. Now, in our example, let's assume this is a 80-20 split. Once again, these number percentages are going to be done on the basis of multilateral negotiations, and they're not bilateral negotiations, they're multilateral negotiations. So in our example, let's say that 20% of the deemed non-routine profit margin is allocated to the markets. So 6% of the overall EBT margin will be allocated to market-related activities. So the group's market-related profits is determined to be around 6% of the overall revenues. So if I just do my simple calculation, so 1 billion was the group sales, and 1 billion into 6% will be around 60 million. And this 60 million would be the amount A taxable base. And this taxable base would be reallocated back to the market countries in accordance with the proportion of revenues derived from each market country. So for example, because Netherlands had 10% of local sales, so Netherlands would be allocated 6 million of that profit. Germany had 20% of the local sales, so Germany will be allocated 12 million of that profit. And France had around 30% of local sales, so France will be allocated 30% of that profit. And local corporate income tax in each country will have to be paid on this amount, deemed amounts. With respect to amount B, amount relevant here in our example because it fixes the arm's length remuneration for the limited risk distributor in Germany, whereas amount C applies to the full-fledged distributor in France. According to my calculation, let's just assume that the local under the current rules, the amount B taxable base in Germany is around 4, and that would be its local taxable base. Whereas with respect to amount C, and this is very tricky because amount C also allocates a part of residual profits to the market countries, and then amount A also allocates a part of residual profits to the market countries. So there could be an overlap between amount A and amount C. And then the question arises, which amount prevails, amount C or amount A? But once again, there is no consensus on this point as of now. So we have to just wait and watch with what the OECD is going to come out on the relationship between amount A and amount C and how to address that overlap. So post Pillar 1, this is how this structure will look like. So like I mentioned to you, in the market countries, in pre-Pillar 1, the sales were being made in the Netherlands on a remote basis. The Netherlands will get an amount A allocation. Germany will get an amount A allocation as well as an amount B allocation. Amount B because it's operating through a limited risk distributor. And France will get an amount A and an amount C allocation. But there is a certain overlap between amount A and C, and this has to be taken into consideration. And we have to see what the OECD proposes with respect to how these two amounts, A and C, will cooperate with each other. So because these taxes will be paid in the market countries on the taxable profit that will be allocated to these countries, some entities within the group have to provide relief. So in our example, the relief will have to be provided, for example, by the principal or by the parent, because the principal or the parent, they are the entities who are going to be booking residual profits of within the multinational group. Before I move on to the next example, I just wanted to ask Rajesh whether I still have time to go through this example.
Vikram, I think we are running out of time, but if you can wrap up in 2 minutes or so, that'll be great.
Okay, so just to do a very simple example once again. So if you take an online advertiser example, and we can just look at the Facebook kind of business model. So let's just assume that we have Facebook or Instagram or Twitter or any of these online platforms, and they are receiving substantial business income from their business clients. And these advertisements which their clients want these companies and the advertisements of these clients. So for example, you could have BMW, which is advertising on the Instagram platform or Facebook platform. So that's actually a B2B transaction. And let's just assume that you have these business clients, and these business clients are telling Facebook, Twitter, or Instagram that they have to show ads to user bases in the Netherlands, in France, and in Germany. And here, in this kind of situation, if we just go ahead and we assume some more facts, and let's just assume that we have, once again, the group F is operating, its global revenue is around 1 billion, expenses 600 million, profits 400 million, and it has a user base. 10% of its global user base is coming from Netherlands, 20% from Germany, and 30% from France. With respect to an amount A allocation, once again, we we need to see whether Group F falls within the unified approach. And the answer to that is yes. It's an automated digital service business, so it will fall within scope. And because its revenue exceeds 750 million, the revenue threshold is met at a group level. With respect to nexus, the nexus here would actually you would need to see to which country is the nexus going to be attributed. And in this kind of situation, the nexus will be somehow sourced to the user countries here. And with respect to profit allocation, once again, we have different amounts. We have amount A, and we've already done this example, so I will not repeat it. So at the end, what will happen in respect to digital or highly digitalized service business models is that these highly digitalized business service models, interestingly, in step 3, the split between production and market related activities could be different for highly digitalized business models. And in my example, I just assume that the split will be between trade and marketing related activities will be 60-40 split. Somehow, if you look at the Indian approach on profit attribution, the Indian report which was released by the CBDT also had mentioned that in some kind of businesses, users play a more prominent role, and because of that, a higher profit should be allocated to these businesses with respect to the user networks in India. And they had given examples of online on companies which were essentially online advertisers. So in our example, if we apply once again the 4-step approach, you will come to the conclusion that 120 million would be the profits, which will be at 120 million will be the total amount A allocation which needs to takes place. And this allocation will be allocated to not the country where the multinational has its business clients from, but where the user base of the multinational actually exists. And because the multinational has 10%, 20%, and 30% of its global user base in Netherlands, Germany, and France, these countries will be allocated a certain portion of the profit. So post pillar 1, this is how the profit allocation mechanism would actually look like. So you will have Facebook, Instagram, or Twitter paying taxes, amount A related taxes in France, Germany, and the Netherlands. And then the entity which is there in the head office in Ireland or in the US will have to provide for relief. I will skip the economic assessment, but the economic assessment is pretty logical. It says that market countries will be allocated more profits, and then you will have some winner jurisdictions, and then you will have some loser jurisdictions, the winner jurisdictions being the big markets, and the loser jurisdictions being typically the countries where multinationals operate with centralized business models. And I think, Rajesh, with that, I will stop here because I think everything else is self-explanatory, and like I mentioned, investment hubs are the ones which will lose out the most in this entire proposal.
Sure. Thanks, Vikram. And I think I know we are already sort of running behind time, so I do want to get Dr. Radhakishan Rawal in terms of trying to give the Indian perspective. While the global scenario we are trying to move towards Pillar One, we are also looking at the Indian approach, which is still the significant economic presence. Again, before I part with Dr. Chand for the time being, there are a bunch of questions which we have seen, which we'll come back to later. And also for all the participants who may not know Dr. Chand, he teaches international tax policy at the University of Lausanne. Thanks, Vikram. That was a wonderful presentation. And we will come back to you again for the Q&A in some time. But now over to you, Dr. Radhakishan Rawal, on the Indian approach, because we are still one step behind, or in some words, we are probably the first out of the block trying to ensure that we expand the base in terms of trying to get a lot of digital transactions within the tax net. But to you, Dr. Rawal, in terms of what India has been doing on taxation of the digital economy.
Okay, thanks, Rajesh. Two opening things. I don't know whether I have, the control is with me to bring the file here. It would really look good if I was really a person with a doctorate degree, but unfortunately I'm not. So I'm not Dr. Radhakishan. I'm normal Radhakishan Rawal. Anyway, so I think that was a very good presentation, by Vikram on what's happening at the OECD level. What I've done is that we have a number of sessions in this series. So what I've done is that I've tried to structure my presentation in a manner that we focus on something which is happening in India in response to the digital economy. So I'm focusing predominantly on the Indian measures, what the Indian government has been doing to address these issues. I'm taking some macro approach and thereafter a lot of micro approach to analyze the provisions in far more detail. So if I have to kind of project how does Indian approach to digital economy look like? Okay, the picture which gets created would be something like this. Okay, we'll have number of provisions targeting the same income. So we have section 5, which is income accruing arising in India, or income deemed to accrue arise in India, or receivable deemed to receive in India, which is by itself very broad. We have a section 911, which is a deeming provision, deals with business connection, a concept which is very broad in nature. Okay, a lot of things could be covered within that. These two things were very wide enough. Yet the government thought of coming up with explanation 2A, which is significant economic presence. Then we have explanation 3A. These provisions are becoming operational. The recent provisions in the law with this advertisement and data. We have equalization levy, which came in 2016, 2%, which was on advertisement predominantly. And then finally, we have equalization levy at the rate of 2% now, which is on the e-commerce transactions. We also have a strategy, or provisions in the indirect tax law. We had a concept of OIDAR, which has been operational till from 2017 onwards as a part of the GST law, and even earlier, it prevailed for some point of time and under the service tax law. So, on the whole, if the Indian government may be doing, it seems to be doing multiple things. There is a lot of overlap, which prevails, between these provisions. However, there are provisions like Section 1050, which would kind of remove the overlap. Within the equalization levy provisions, there's a mechanism to remove the overlap. But on the whole, picture looks, quite complicated. So, having noted the broader picture, I will, now focus a little bit on explanation 3A, which is a new provision, which has been introduced by the Finance Act 2020. So, just to give you, a very broad understanding of Section 9, we have a Section 9 which says that 911, which deals with income from assets in India or property in India, or business connection in India. So which is kind of the deeming charging provision. Thereafter, we have explanation 1. Okay, explanation 1 predominantly says that the income which is attributable to the transactions or operations carried out in India is something which is subjected to tax in India. Okay, and now then we have this explanation 3A, which is a new provision coming in, and it says for the removal of doubt, and this language is very important because it creates some confusion to understand what is it trying to say. It is hereby declared that the income attributable to the operations carried out in India, as referred to in explanation 1, shall include income from the advertisement income and data sale of data. So if we think what exactly is this explanation trying to do? Okay, we have a concept of business connection. We have a concept of operations in explanation 1A. What does this what is that this explanation trying to do? Now so after some analysis, one may come to a conclusion that essentially what it's trying to do is creating a sort of a dimming fiction, and this dimming fiction essentially includes the categories of income as income from operations carried out in India. Okay, so if we carefully examine this language, this is kind of an assertion which we can make that explanation 3A effectively appears to be creating a dimming fiction, and as per the dimming fiction, the income from the income of advertisement and income from sale of data is to be treated as income from operations carried out in India. Well, good enough. Now, one may think of in this way that why this dimming fiction and was it required? Okay, and then one may think of looking at some of the old cases, and then we have a Supreme Court case in the case of Supreme Court judgment in the case of Anglo-French 1953 case, and which essentially says that it's not each and every business operation, each and every business function can be seen as triggering a taxing right to the Indian government. So probably there is somewhere there's a written, maybe unwritten concept of business operations which would trigger taxing right, which would entitle India to levy tax. And there you'll find a number of cases which says that these are the operations which are not significant operations based on which one could get a taxing right. So one kind of presumption could be that the approach behind this dimming fiction in explanation 3A is to specify this operations or this income as resulting from operations which could be subjected to tax in India. Now we look at what are the operations which get performed in India in terms of clause 3A. The advertisement, will be viewed in India. In the context of advertisement, the advertisements would be accessed from India. The data collection would happen in India for clauses 2 and 3 in the context of data. So, one may have to think through, whether these are the operations which, in general parlance, would have, triggered a taxing right in India. And maybe probably the government is trying to clarify this, that these are the operations which would result in a taxing right in terms of explanation 3A. Now, very interestingly, we have a kind of a perception, we have a concept, which is coming out from a number of cases. Recently, we saw the judgment come from Supreme Court on liaison offices, the UAE exchange case. And a lot of the issues around liaison offices, probably were also linked to this perception that certain business operations, would not trigger a taxable event. So, having noted, this particular interpretation, and that's how I want to interpret. I would want to interpret this explanation 3A. Let's move on to another Supreme Court judgment, which is in the case of Performing Rights Society. I would say one of my favorite judgments to understand how the Indian system operates. In this case, a UK-based society had given rights to All India Radio to play Western music to India. The Western music would be played in India, and the society would be entitled to receive a royalty from the All India Radio. The issue reached the Supreme Court about the taxability of this income. the Supreme Court said that it's very common sense approach that the income in this case accrues in India, because the consumption of the music happens in India. Okay, so in section 5 itself, there's a concept of accruing in India, which is wide enough to bring this income to tax. Okay, and one need not necessarily look at the diminishing friction, which is there in section 911. So it's very important to kind of refresh our memories on these case laws, because it may appear that a lot of things which explanation 2 or maybe explanation 2A or 3A is trying to do may already have been there, in terms of this this ratios which are laid down by the Supreme Court. You have economic consumptions happening in India, and by virtue of that, the income accrues in India. So it's like a straightforward kind of a ratio, no further things required. Having said that, and this is a 1977 case law. Let's look at the latest tribunal ruling which got announced about a couple of weeks back. And again, a very interesting ruling, I would say. So this is a case where Volkswagen had organized a launch event in Dubai. Okay, and then they had kind of appointed or engaged this Hollywood star Nicolas Cage. He is on the screen to be there, in the event for about 3 hours. He was paid a very huge sum of money. About 150 participants, from India were flown to Dubai for this event, and it was a very luxurious, kind of event, to launch a car, a luxury car. It was very obvious that the manner in which the event was organized, it was India-centric event. In that sense, the benefits of this event, were to be availed or utilized in India. The tribunal has seen a concept of below the line publicity, wherein the publicity or the visibility is obtained through social media, or not through the main advertisement in the media. Okay, but it happens subsequent to the event, and that's why the tribunal has taken note of this concept. The finding of the tribunal is that although the event happened outside India, the event was meant for the purpose of economic benefit in India after the event. The Indian entity had claimed the expenditure under domestic law under section 37(1). So there was a clear nexus, there was a clear benefit test, which the SSC of the Indian company himself established. And that's why the tribunal said that because this benefit, because this event in Dubai benefits Indian population or the Indian company in India, the income is having business connection in India. So the non-resident recipient, the Hollywood star got the amount paid through a US company. The tribunal said that the US company is subject to tax in India on this income. Tribunal has brought in the concept of intangible business connection. The tribunal has observed that this concept probably did not feature in any of the earlier cases. It's a very interesting ruling, because again, if we see the event happened outside India, and the tribunal has managed to come to a conclusion that by virtue of concept of business connection, income is subject to tax in India. Very interestingly, the text of the tribunal, text of the ruling, text of the order does not appear to be giving a lot of guidance as to what was the tribunal's observation on the explanation of the section 911, because the explanation says that income can be taxed in India to the extent the operations carried out in India. So there's not much of observation in the ruling of the tribunal about the operations which were performed in India. But nonetheless, the concept of intangible business connection with the tribunal has brought in is very important. And again, this concept, this kind of a ruling makes us think, as to we already have kind of provisions in the domestic law which have far-reaching implications if applied or invoked. I'm again, bringing up a very interesting observation, from the tribunal order. The tribunal has observed, commented on the past judicial precedents. Okay, but what ultimately the tribunal says that, well, these cases were given maybe about 50, 60, 70 years back. now the business models have significantly changed. Okay, so and then there's a fundamental change in the business model, there's a fundamental way in which the business is conducted, and that's why this requires kind of a fresh look, a different thinking altogether. A very interesting observation, and maybe I'll keep on using the slides for a few years to come in my presentations. A relevant question which comes here is that and then in this series which Nishith has started, we're going to have, we already had a good discussion about the constitutional aspect of these new provisions. There are a lot of issues about are these provisions or the provisions around liquidation levy, is there a territorial nexus, is it extra territorial matter and all that. My question would be, and I'm not an expert on constitution, but my question would be that would not the international discussion and the global consensus which is emerging about taxation of digital economy, is it not fundamentally shifting the concept of territorial nexus itself? And would not the constitutional matters when they reach the court, would they not be influenced by this new business model? Because you have a judicial tribunal order here, which clearly takes note of the change in business model, and it could happen when the matter comes up for constitutional matters as well. As I said, I'm not an expert. Fortunately, I have to only raise doubts, and maybe we'll have some answers from the lawyers. There are a couple of other issues which arise. Is that well, explanation 3A creates some kind of a dimming provision, but to create the provision to bring the income to tax, there must be a business connection. So which is not clearly stated, but that's kind of a a very categorical provision, a categorical requirement of Section 9 itself. There must be a business connection to bring this income to tax in India. There is a very confusing or suspicious provision which is given in explanation 3A, which is far more difficult to understand what they are trying to do. They are trying to say that the entire provision which is provided in explanation 3A shall also apply to explanation 2A. Now there are far more difficulties in this linking the two. They are starting operational for different years, and then again certain things which is there in relation to SCP is getting taken out of explanation 1. So that's we'll have to wait and see how does this provision to explanation 3A gets interpreted. Few more questions now, and now we go to the balance sublimes of this new provision. It is levying tax on the income from advertisement which target a customer who's residing in India or who's accessing advertisement through internet protocol. Now, my question here would be that, well, who is a customer? Okay, is customer someone who is already my client, who is already availing my goods and services, or someone who has no connection with me at all, could also be said to be a customer? And this question comes up because when we look at a similar law in some other country, the word they've used there is public or a person, as against using a word customer. Again, the question would be, is it only internet advertisement which get covered here, or even the TV advertisement get covered here, or even the indirect TV advertisement which get covered here? So let's take a very simple example. We don't know where the cricket matches will start in the ground now, but invariably when we see the cricket matches on the TV, be it in Australia, New Zealand, England, wherever, on the boundary lines you will see the products being advertised which are meant for Indian consumption. Okay, nobody would probably eat pan parag or those life boys soap or Usha kind of a thing in Australia or New Zealand. They are predominantly placed there on those boundary lines, so that the people in India, when they see these matches live, they are able to see this. So, a question will also come up as to, whether this new provision is meant only for, this internet advertisement, or even the TV ads will get covered up, or even the media ads will be covered. I'll take one simple example, and again there's some confusion in the language which comes up. What is to be subjected to tax in India is sale of data collected from a person who resides in India. Now let's take a very simple example. The company A is selecting data from India. So the data collection happens in India, and this data is sold by A Limited to Y Limited. So this is the first transaction, which is obviously subject to tax in India, because that's a sale of data collected from a person in India. Now, what happens when the same data gets sold from Y to Z and Z to U? Okay, the data probably still be labeled or said as data collected from India, but as a policy, will it be good to levy tax on that as well? Or one is to say that, well, after first sale, the data is to be said to be data purchased from India, and it is to be distinguished in that sense, and it's not ideal to levy tax on that again. Similarly, there are questions about usage of data, sale of goods or services using data collected from India. A lot of things could be done after data gets collected from India. Data can be used for directly selling goods or services, or the data can be used for improvising the products, or data can be used for internal purposes like HR or admin or whatever other function. Now, out of all these activities, what is what gets triggered, or what is to be subjected to tax when a sale can be said to be made using a data collected from India? In which provision, which cases the provision is to be applied? That's going to be a question, and we'll have some likely to have some disputes around that unless there's a very clear guidance which is given by the authorities. Okay, Rajesh, how much time do I have? Because this is a comparable example. I can skip this.
Okay, you can do another 3 minutes.
Okay, fine, great. So maybe I'll skip this example. There are some inconsistencies which I find now in section 9, because you have explanation to section 9 1B and 1C which creates some kind of an exemption. Okay, when the product is purchased from India for the purpose of export, there's an exemption. Similarly, the shooting of movie and all that, or news collection, that also creates an exemption. But when the data is collected from India and sold outside India, that that's now treated as a taxable. So is there economic justification or there's some inconsistency? That's going to be a question mark. Having said that, I just want to spend 2 minutes on the issue of attribution. And I'll define the attribution issue in my way. To my mind, the question of attribution is how much profit should be taxed in a source country. So let's say, take a very simple example. In a cross-border transaction where country A, where a profit of 100 is made, and 2 functions are performed in country A and 2 functions are performed in country B. Okay, on what basis the amount of 100 gets distributed between 2 countries? Should it be 50-50? Should it be 20-80? Should it be 30-70? In what proportion? This, to my mind, is the core issue of attribution. Transfer pricing and arm's length, does not necessarily completely address the issue. Transfer pricing kicks in, when one has to determine arm's length pricing between related parties. But the issue which I am saying here, issue of attribution, is essentially a fundamental issue. It's I would say it's a sovereign right for a country to determine how much profit it should be taxing from a particular transaction. So all these years, we clearly did not have this statutory guidance on the attribution. We can say section 5, section 9, section 145. This all kind of default rules, but it did not categorically tell us that if a function performs a certain profits, how much profit should be taxed in India. And and that did result in a lot of litigation. And then we have certain interesting observations. Especially I'm looking at observations. I mean, the judicial authorities, higher up, said that well, essentially attribution is turning out to be a guesswork, and we don't want to get engaged in a guesswork. Way back in 1976, Supreme Court said that we need a certain statutory guidance in the form of a formula, or some method to determine what proportion of income should be subject to tax in India. And then when I look at the current developments, I find that probably now we have reached a stage wherein we are now going towards accepting some formula. because all the problems, are not necessarily transfer pricing problems, and all the problems that do not get, addressed to transfer pricing. So we have, draft rule 10, which is now going towards some formula. We're expecting two set of rules in terms of section 295, okay, wherein, one will have to wait and watch how this, issue gets sorted out. But, I believe that, this probably the most appropriate time, to talk about, this issue of attribution, because the world, appears to be now, moving towards, some sort of formula. So that's kind of very interesting development to my mind. And Rajesh, with that, I'll stop my presentation here.
Thanks, Radhakishan. I know we've gone slightly over time, but I do want to spend, at least because there've been quite a few questions which have come. So I do want to take around 5 to 10 minutes just to pick up on some of the questions. And probably Vikram, if you're on, I think a couple of quick questions and what I see from what participants have been talking about. In terms of one is in terms of calculation of the EBT, right? In terms of, do you just follow accounting principles? Do you take into account depreciation, interest? I know you've dealt with some of those in the paper, but will be good to sort of spend a couple of minutes around that.
Yes, sure. In order to calculate the profit before tax, the idea here is just to look into the consolidated financial statements of a multinational enterprise. So if you just look at the consolidated P&L of any big multinational, you have the income, and then you have the various expenses, and then you have your interest and financial expenses, and finally you have your profit before tax. So the starting point of this proposal is using this profit before tax amount, and this profit before tax amount could be adjusted by certain extraordinary activities or extraordinary expenses. For example, it could be adjusted for some expenses incurred for extraordinary expenses in relation to acquisition of companies or M&A transactions, so on and so forth. So indeed, the idea here is not look into the consolidated financial statements of an M&E group. The issue arises if a M&E group has more than one business. So you can imagine a situation where you have a multinational enterprise. If you take the example of a big diversified multinational, and a multinational can have one business line which is selling goods, another business line which is providing some kind of services. So when a multinational has different business lines, that's when the tricky issues come up with respect to how do you determine the profits of each and every business line, because the proposal which the OECD is developing follows an M&E business line approach.
Sure. And Vikram, just one point. And again, today, how do you sort of view things? Because even when it comes to EBT, right, or trying to calculate earnings, different countries have different accounting guidance, right? Some may follow IFRS, US GAAP, you have the Indian accounting standards. But wouldn't the basic block trying to see that, okay, let's have a common sort of standards even around that? Is that something that you would expect OECD to provide guidance on?
No, I don't think the OECD is going to develop some new international accounting standards. So what they will essentially say is that the standard which is applicable in the ultimate parent company of the multinational group, that will be the relevant standard that will be used to determine the profit before tax figure of the multinational enterprise. So for example, if you have a Japanese multinational headquartered in Japan with the ultimate parent company there, then you will use Japanese GAAP. Or you may use, if you have a US multinational, you may use a US GAAP. Or some other multinationals, they use IFRS, which is somehow a common standard. So what I'm assuming is that it could either be the local, the accounts prepared as per the consolidated accounts prepared as per the local GAAP of the particular country, or IFRS. But I'm assuming there will be somehow a trend towards using IFRS.
Sure. And I think the second part, and for me, what I really see as the bigger picture is that you cannot have pillar one working in isolation without having a strong, well, whether we call it by any other name, but a strong dispute resolution mechanism. Because the whole approach, in some sense, is intended to try and avoid the other set of litigation which we otherwise tend to have. And when I come to Radhakishan also, just the sheer quantum of litigation, for example, anyone who's practicing in India, and you see the number of cases which are there in tribunal, and each time people are trying to push the limits in terms of what is territorial nexus, how do we increase the scope. I think two questions, one to Vikram and one probably to Radhakishan, in terms of how do you foresee the dispute resolution mechanism evolving? And Radhakishan, do you see India actually agreeing to any kind of dispute resolution if you want Pillar 1 to work, or India will still want to push ahead on a unilateral approach?
So maybe I'll go first. So Rajesh, I think India has been, very vocal against, arbitration. So it's unlikely that India will prefer arbitration, but still India is a part of inclusive framework, and then maybe there's a commitment to agree on a solution agreeable to all. So and that's why Vikram also said that they'll come up with something, but they'll not call it arbitration. So something which is arbitration, which is India is unlikely to accept. The other day someone talked about conciliation proceedings, so that's something which is interesting. But I would say one will have to wait and watch how this things evolve. But it is undoubtedly very important that we have a very strong dispute resolution mechanism. Otherwise this pillar 1 amount A, amount B, I see turning out to be huge amount of dispute.
Just to add on to what Radha just mentioned, now when you talk about dispute prevention and resolution, you should, with respect to the unified approach of the OECD, you should make a distinction between the dispute prevention and resolution mechanism for amount A and the ones which are for amount B and C. Now for amount A, which is an add-on to the existing international tax system, the rules would, at least the idea is that the rules are going to be so clear, the profit allocation amounts are going to be determined in a very simple manner, so that the tax bill will be paid by, let's say if you have an American multinational, so the American multinational, which is headquartered in the US, for example, Google will pay the tax bill to the US tax administration for amount A, and the US tax administration will then send out that to the respective country, their respective amount A allocations. So here the idea is that from a dispute side, dispute resolution side, is that for example, the Indians won't be able to challenge the amount A allocation with respect to any amount being allocated to India, because the rules will be so clearly developed that there would be no scope for a challenge to be initiated, because in what the amount A would try to seek to do is that the only person who can challenge this allocation is the US tax administration and not the Indian tax administration. Because if all the tax administration across the world start challenging amount A allocations, it's going to become a big mess. So they will somehow try to curtail the powers of tax administrations also to challenge of market countries to challenge amount A allocations. Whereas for amount B and C, the idea is it's within the existing system. And if it's within the existing system, countries can do whatever they want.
So moving the topic a little bit and going to Radhakishan on the Volkswagen case, because I did see a comment from Daksha in terms of how do you sort of view the Volkswagen case in terms of, has it gone beyond what the parliament had essentially envisaged? While the point that you made saying that yes, business models evolve and the law has to be sort of interpreted in light of new business models. But is it also a case that you are now trying to stretch the law going beyond what is actually there and going into something where if the government wants to do a policy prescription in terms of getting a new legislation, do that rather than trying to interpret the law as it stands beyond what it was actually envisaged for?
Rajesh and Daksha, that's really a very interesting question, and this Volkswagen judgment has become a very favorite judgment for me, at least in the in last couple of weeks. Now, the way I see it, I see the concept of business connection is very wide. Is very wide, and probably it's so fluid, and the term has still remained undefined, okay, after maybe more than 100 years of existence in the Indian law. And that's why it's a very common word they've used. And probably I will say there's nothing wrong if the interpretation of the word keeps on changing depending on the business model. Okay, because business connection does not necessarily talks about having some presence, some sort of a presence in India. And it's kind of a relationship between some business carried on outside India and some business carried on in India. So as far as the interpretation of the term goes, well, I mean, it is a bit subjective, but I don't see that to be getting stretched too much. It would be much more beneficial to all of us if there was a good amount of discussion in the case, in the judgment, on the aspect of operations carried out in India, because that explanation 1A category talks about that's something which is adequately not getting discussed there. On the aspect of Vienna Convention and in good faith. I would say there is very little, in the case law around this aspect, because they've gone into Article 23(3), okay, and it says that it gives taxing rights to the country in which the income accrues or arises, and then what Tribunal has done is that simply adopted the interpretation of the word accruing arising in the domestic law, for the purpose of Article 23(3) itself. Although it's said that income is deemed to accrue or arise in India, and that deeming fiction is treated, as accrual for the purpose of Article 23(3). But beyond that, there's not much of discussion, about whether this is a good faith interpretation of the treaty. The judgment does not deal with that. Probably even the it doesn't seem that aspect was ever argued before the tribunal.
Thanks, Radhakishan. I think I do see other questions, but I know we are running out of time. So I think some of those we'll have to probably take it offline, because we've gone at least 15 minutes past the scheduled close. So why don't I just give it to Nishith for some closing remarks before we sort of wrap up for the day.
Yes, I'll just take 60 seconds and make a quick comment. Thank you so much. Wonderful exposition, Vikram and Radhakishan, and of course RS for a comment. But very quickly, one, as Vikram mentioned, I think on Monday we'll be discussing one world, one tax. Somewhere along the line, the whole thing has become so overlapping, as Radhakishan pointed out. It is tax people have gone completely berserk as to how to handle this whole situation, and tax imperialism is the expression I've been using for some time. I think is becoming more and more common, and we'll have to find a way out, and we'll be discussing on Monday. Another one small thing I thought after all this discussion, which is missed out. See, expression is not just business connection. It is business connection in India. Now, as Radhakishan was mentioning, business connection may be a wide concept, but it's narrowed down by the word in India. So there are two expressions. One, business connection with India, and business connection in India. In India has slightly narrower connotation than business connection with India. And traditionally, original concepts of income tax provided that business connections cannot result in taxation because that is not creating a sufficient nexus. Nexus is not important alone. So there must be sufficient nexus. And therefore, unless there is sufficient nexus, then you cannot tax that transaction. So it was narrowed down by use of the word business connection in India. So if you see the expression, real expression ultimately is business connection in India. And I think we'll discuss some of those things on Monday. For the time being, I don't want to take too much time, but I would only close this by saying that tomorrow we have even very interesting discussion. David Rosenblum will talk about tax disputes resolution mechanisms, and Clive Baxter will also be talking to us on on the subject of tax policies and stuff like that. It would be very, very interesting. Do come back tomorrow. I am aware that we have taken a little more time, but I thought if we don't get this kind of opportunity, and therefore we have been slightly liberal in extending the session. Grateful to you all. Thank you for your patience. And everybody, thanks once again. Good night. Welcome.